Welcome back everyone. So we are going to attempt a very simple depreciation calculation just to illustrate the mechanics of how depreciation is calculated, as well as to illustrate the importance of book value. Okay, so you have just purchased an ice cream cart for $30,000 today and need to figure out how much you can depreciate this asset by each year. This information will help you figure out the tax benefit you will gain from the depreciation of the asset. The ice cream cart is estimated to have a useful lifespan of 3 years. Develop a depreciation schedule for the ice cream cart detailing the depreciation amount each year as well as the book value. Use the straight line method. So just to summarize guys, book value is just the value of an asset on the company's balance sheets. Okay, and the depreciation amount each year for this particular asset will be the same because we're using the straight line method. So as you all know, because you're very diligent students, depreciation is equal to the initial cost divided by the useful lifespan. Okay, so the depreciation for the ice cream cart is equal to its initial cost, which is $30,000, divided by its useful lifespan, which is 3 years. Okay, 30,000 divided by 3, and that should give you a depreciation of $10,000 per year. Alright, so now all we need to do is calculate or form the depreciation schedule, and the depreciation schedule is just a way to show the book value of an asset over time, as well as how much the asset is depreciating each year. Okay, so let's make our depreciation schedule. So we'll have the year, we'll have the depreciation amount here, and we'll have the book value. Okay, so we'll have year 0, 1, 2, and 3. So in year 0, nothing's depreciated. You've just purchased the asset. There hasn't been time for the asset to reduce in value. So the book value will just equal its initial cost, and the initial cost of this ice cream cart is $30,000. Okay, so for years 1, 2, and 3, because we're using straight line depreciation means that the depreciation per year is the same. Okay, so the depreciation each year is just $10,000. Alright, now we need to calculate the book value for each of these years. So the book value is just equal, so the book value for year 1 is just equal to the book value in the previous year, so 30,000, minus the depreciation that I incurred that year. So because 1 year has passed, the value of the asset has now reduced by $10,000. Alright, based on our accounting system. So that just gives us a book value of $20,000 in year 1. Okay, so similarly, the book value in year 2 will be the previous year's book value, so 20,000, minus the current year's depreciation, which is 10,000. And again, that gives us a book value of $10,000. And the very last one, the book value in year 3, will be the previous year's book value, which is 10,000, minus the depreciation that year, which is 10,000. And that will give us a book value of 0. Okay, so a book value of 0 in year 3 makes sense because the useful lifespan of our asset is 3 years. And after 3 years, it is expected that the asset is no longer of use to the business. So that's why it's 0 here. So the main reason why I got you to calculate a very simple depreciation schedule was to highlight the importance of calculating book value for the disposal of assets. Okay, so what I mean by that is, say for example, in year 2, right, I decide to sell my particular ice cream cart. Okay, so for tax purposes, what I need to do is calculate the my book value for my asset, and the book value for my asset is $20,000. So I need that in addition to my selling price of the ice cream cart to work out my tax obligations. So it might be easier just to show you via an example. Okay, so with respect to our tax system with assets, you only tax on what they call the capital gain or the gain on sale. Okay, so the gain on sale is simply equal to the selling price, so what you sold an asset for, minus the book value of that particular asset. Okay, so because we're selling it in year 1, right, it'll be the book value in year 1. And let's just assume, for argument's sake, that we're selling this particular ice cream cart for $25,000. Okay, which is not too bad. 25,000. Okay, so the gain on sale in this particular case will be 25,000 minus our book value in year 1, which we calculated to be 20,000. And that evaluates to a gain on sale of $5,000. Okay, so our taxation system doesn't tax us on the entire sale amount. It only taxes us on what it deems to be the gain on sale. And that's why calculating the book value is important, because you need to know what the book value is to figure out what your gain on sale is and what amount is actually taxable. So our tax amount that we actually have to pay the government will be our gain on sale, so 5,000, times our applicable tax rate. So for argument's sake, let's just say our tax rate is equal to 30%. Okay, so it's times 0.30, and that gives us a tax obligation of $1,500 that we need to pay the government. And we have to pay tax because essentially we've made a profit on the sale of our asset relative to the book value of our asset. Okay, so we sold our asset for $25,000, which is higher than the book value of our asset of $20,000. So the government or the tax system recognizes that as a profit upon sale, and that means we need to pay tax of 30% on that profit of this $5,000. Okay, and that's it, guys. All the best.